Okay, I hope everyone can see the slides. So good afternoon, and hope everyone is well and safe. This is my first time doing a webinar. I can't see everybody, which is very unusual compared to all the seminars that we normally do face to face. So my apologies if anything doesn't go right. It's my first time, so and I hope you all find this today's session informative. So essentially, before all this happened, I recall many asked about the 10-year cycle and what would tip the world into the next recession. And I think a pandemic probably was least expected. And this is what we call a black swan event and completely unprecedented. So even if you were to call it, I think people will say it's very soy. So, I mean, there was a H1N1 in 2009 and 2010, but back then I think there was a vaccine and it wasn't to this scale. So at this juncture, I think the earliest a vaccine can be commercially available, or at least from what I read, is that it would be a year from now. And until then, I think generally when we do our projections, we assume that there will be continued caution and ongoing containment measures. Um, and I think what makes this crisis different from all the others is that essentially it stems from a health crisis, and then it becomes an economic crisis, and it morphs into a financial crisis. So I think these are some of the things that to keep in mind, especially when we're dealing with this situation now. Uh, so okay. Um, Right. So I think what we've seen so far to date is that there's been trillions of liquidity pumped into the system, the global system. I think that's helped to stabilize the financial markets. That's why you've seen, I think, equity markets have stabilized somewhat. But I think the economic costs will continue to rise as long as some of these containment and lockdown measures are in place. So if you are a business, I think this is probably the time when if you have some kind of online exposure, then it ensures continuity of business. If you have exposure to China or Asia, I think that also helps. Um, that also helps, especially when developed countries are shut. And obviously, in times like these, essential items are preferred over luxury or discretionary items. And finally, if you have savings and wondering that if this is the time to enter the markets, I say from a macro perspective, there is still a lot of uncertainty ahead. So let me start. I have 18 slides and 18 slides. So firstly, I think just to give you a quick update about the COVID-19 global cases at this juncture, I think the latest is that in fact it's already crossed 2.7 million. The fatality rate is still quite, it's not as high as SARS. It's at about 6.9%. But I think, as I said, there is no vaccine at this juncture, so that's why I think there's still a lot of caution. And basically, there's still a lot that's unknown about this pandemic, and you can see that there are fractions of cases that are very severe and also very critical. Um, in terms of the cases, I think we can see is that the epicenter has actually moved to the US. If you see from here, you can see that actually US has the highest number of cases now, and other countries have actually the ones that have that saw it surge earlier and they introduced containment measures. Those countries have actually started to see their cases sort of flatten, and so it shows that some of the containment measures that they had are probably having some effect to help. But I think the concern is that there could be a second wave for infections, and that's probably why also that Malaysia has extended our MCO. Now, if you look at the global indicators, I think it's a bit early now to see really what is the real impact. Let me just draw this down. I mean, in terms of China, you can see that immediately after they, when they did their lockdown, you can see that their PMIs actually, halved And after that, subsequently, when they reopened, the PMIs rebounded. But at that time, a lot of other countries went into shutdown. So the first indicators that we are seeing would be like the PMIs showing that the activity has slowed drastically, especially for the services and also the manufacturing sector. Now, in terms of the equity markets, you can see that the index has actually has actually stabilized. But as I said, that I think it's probably still too early to call it a bottom, because I think there's still a lot of uncertainties and unknowns. We've seen that oil and gas prices have actually collapsed in the last week. And I think that's also partly because the futures contracts actually went into negative. And in the US, we have seen that jobless claims have actually spiked up. The unemployment rate has gone to 4%, but I think the latest count, some are even suggesting that the unemployment rate in the US could go to double digit or around 20%. So all in, I think that so far the numbers, even the GDP numbers of first quarter, all showing that actually the impact of it is felt very broadly across the economy. If you look at, in fact, oil prices for that matter, I know while markets were hoping that a deal between the OPEC members would actually help to stabilize oil prices. But what we found is that it wasn't sufficient to offset the bigger drop in demand that was projected by the EIA and the IEA. So in essence, I don't think it helped very much. And as I said, because of the when US WTI futures went below zero, the selling accelerated because there was a lack of storage space to hold the excess crude. So what you're seeing is that a lot of them are actually rolling over their contracts, and I think the question is when we could see some stabilization of this, right? So for now, we are actually seeing that the oil prices slumping below, obviously $30. There is also concern about the impact on Malaysia and also on the ringgit, right? So as a result of the fallout, you can see that all the countries have actually announced massive stimulus measures. Malaysia is there, 260 billion ringgit, 80% of GDP, a relief package. And you can also see that a lot of countries have cut their interest rates, and some have actually even cut below the lowest rate levels during the global financial crisis. So, it looks like all the countries, the governments are obviously seeing the severity of the fallout on their economies. But I think what's important, as I said, is with this crisis, right? Because it's health crisis. You don't know when it's going to be to end. Generally, what we feel the shape of this recovery is going to be a U-shaped recovery. What we saw during the Asian financial crisis in 97, 98, the global financial crisis 08, 09, those type of crisis actually had a V shape. And that means it was probably 1 year of very sharp contraction, and then it recovered the next year. We expect to see a recovery next year, but we think that for this year, the weakness will be a more protracted. It could extend for maybe 2 quarters. And if you look at what the IMF has actually projected, so this is the IMF's projection of recovery, they actually see that the most severe or the thick is really in the second quarter. Yeah, because that's when I think globally a lot of economies have locked down. So it contracts sharply in the second quarter, then you will see a smaller contraction going into the third quarter, and then after that recovering towards the end of the year and going into 2021. So I think this is the general perception that as where the recovery path will be for this year. So when we tell the audience that, okay, let's say for Malaysia full year we expect minus 3.5% contraction, but they say that hang on, but second quarter looks really bad. There's no way, it looks like it's going to be more severe. But I guess this path assumes that there could be some recovery in the second half, and that's when the pandemic actually fades and some of the containment measures are gradually lifted, right? So I'd say that I think a lot of these assumptions, like I said, assumes that there will be some kind of recovery by the second half. And I think IMF is very bullish in their expectations for 2021. But I guess at this point, as I said, there's still a lot of uncertainty. And I think from the policy point of view, it also means that governments and central banks are very cautious because they have to be prepared for the possibility that if this situation becomes more extended, more protracted, they have to reserve some stimulus, some fiscal space, or some bullets in their interest rates in case they need to do more, maybe going into the second half. Okay. So I think that's on the part of the global. Like I said, we expect that it will be very severe second quarter. Hope for some recovery in the second half, but I think generally it will still be general caution along the way, and be prepared for people to have a new norm in their way of life until a vaccine is available. So when it comes to Malaysia, we are now in our 6th week of MCO, extended for another 2 weeks. And I think what we have seen is that the government has announced a 260 billion fiscal package, 18% of GDP, and of which the government will directly spend 35 billion ringgit. Okay. So Bank Negara's side, I think they have also cut rates by 50 basis points, and they have also cut the GDP outlook to a range of -2% to 0.5% growth. But I think when we spoke to them about 2 weeks ago, what they told us is that the forecast is actually assuming that the global growth is -1%. Given that IMF is now projecting global growth to be as weak as -3%, I'd say that there are some downside risks to Bank Negara's forecast. So I think what we are looking at, -3.5, I think we have taken into consideration that there could be an extended MCO and a gradual lifting of some of the measures. But I think ultimately what the government is trying to do is still to strike a balance between containment and the economy. And as I said again, also even with Malaysia's indicators at this point, it's not we don't have any first-hand information yet, the degree of the impact or the damage on the economy. What we can see is that sentiment was already quite weak even before COVID-19. In fact, that was when the economy was already slowing down in the fourth quarter of last year. The PMI numbers actually didn't change very little in March. So I wouldn't take that completely at face value. I think that masks a lot of weakness in the manufacturing sector. A survey that was done by DOSM showed that I think the hardest hit coming out of MCO would be the SMEs, particularly the micro SMEs and the self-employed. As you can see, based on their survey, about 47% of the self-employed actually said they have already lost their jobs. The balance of 53% actually say that many have lost their income of more than 90%. So the impact is definitely very severe. And I think at this juncture, Bank Negara is saying that unemployment rate could reach 4% by end of this year. But I think in between now and June, I think the unemployment rate could be much higher. And even on the commodity side, even before the COVID-19, we already saw that crude oil, CPO production was also declined. So again, we already saw weakness in some of the commodity sectors, even before COVID-19 hit. So in terms of just a bit on the fiscal package that the government announced, the fiscal package, what we're seeing is that a lot of it actually, I think the most probably the direct impact would be the cash handouts and the wage subsidies. Then of course there's also the loan funds, the special relief funds by Bank Negara, about total of 8 billion for the SMEs. And then there was also the EPF side, lower EPF contribution, flexibility for EPF withdrawals, flexibility for employers in terms of the EPF contributions on behalf of the employees. We also have a 100 billion bank loan moratorium, and 50 billion credit guarantee scheme by Dana Jamin for the SME. So all this in total 260 billion. And I said the officials actually estimate that package could add at least 2.8 percentage points to the economy. So, but from what I see is that this 2.8 won't actually help to prevent a recession. I think if anything, it will just help to avert a deeper recession at this point. So let's say that I think the main ones are obviously the ones that are directly will feel the most immediate impact would be the cash handouts. And I think they've already started dispersing the cash handouts. It was reported, I think 6.6 million already received close to 5 billion of cash aid. And I think from the SME point of view, I think they find the one that they find most helpful is actually the special relief facility by Bank Negara. So that has actually received 3,000 applications to date. So I think I mean all this will definitely help, but I guess the question is really how protracted this thing is going to be. So I think that's the biggest question also that everyone is asking, and whether all this is enough or not. If you look at the forecast, said Bank Negara has actually slashed their forecast. But what's interesting is that they are still expecting at least a 4% private consumption growth. And I think this really assumes that there will be a rebound in the second half and there will be a release of pent-up demand. So you can imagine that when they slowly start to lift MCO, everyone will be rushing out to get their hair cut or going out on spending sprees. I mean, I'm not sure about that, but that's really their assumption. So I suppose with that, definitely, I mean, there will be some release of pent-up demand, but I guess the biggest weakness will be with the investment side, which we think there will be big contractions, and also on exports. As long as the rest of the world continue to close their borders and they're not buying anything, they're still in lockdown, obviously that's going to put a lot of pressure on our trade sector. So I think that's where I foresee that there will be the biggest area of the biggest pressure, or the biggest area of weakness for the economy. Yeah. In terms of foreign flows, I think even in March we saw that there was a big sell-off of about 17.8 billion ringgit of bonds and equities. And I guess it was not unique to Malaysia. Everyone else has experienced that because of the COVID-19 fears. But so far what we're seeing is that the outflows have not been as steep as during the 08-09 crisis, at least not in March. And I think what we've seen so far is that there were some flows that did come back in, because I think in anticipation of OPR cut. But I think now the worry is the impact of oil prices on the economy and also on the government's fiscal position. Okay. So as you can see, initially yields spiked, but after that, because of the Fed, the liquidity pumping, and I think you see that the yields have actually gradually come back down again. Bond markets were actually rallying in anticipation of the OPR cut. We saw that on Wednesday, the March CPI numbers showed that CPI, we actually saw a deflation, 0.2% in March. Whole year, we're expecting a deflation of maybe prices contracting 0.5%. And that would be the first time Malaysia is seeing a deflation, annual deflation, since 1969. So I'd say definitely there is room for Bank Negara to cut. If you look at even where the US interest rates are, so in terms of with deflation, the real interest rates are already positive. With the Fed cutting their interest rates to 0.25%, there's definitely a lot more room that Bank Negara can ease. So I guess the biggest question is whether they want to use all their bullets at this point. And although markets have already priced in, as you can see from the IRS, the interest rate swap curve, you can see markets already priced in at least a 50 basis point cut, and in the first half of this year. And I think it's a question, like I said, whether Bank Negara thinks that how effective so far are the fiscal measures going to be, and whether there's need for more monetary support. So I think at this point, given that the MCO has been extended further, and what we hear is that even if they do lift, it's going to be on a very gradual basis. So I'd say probably there would be a need to cut interest rates further. Yeah. This will be my last slide. So I think just to share with you on the ringgit outlook, we got a lot of questions from our customers. Was that whether the ringgit would be pegged, especially when it went above 440. I think what's important to know is that at this point, ringgit, as you can see from this chart, is actually moving in tandem with all the other currencies. So we are weakening. Everyone is weakening against the US dollar. In fact, some of the other currencies like the baht, the rupiah, Aussie dollar actually weaken even more than us. And so I think we have to recognize that this is not a balance of payments crisis, or as what we saw back in 97, 98. This is essentially it's a global crisis. So naturally, during a global crisis, risk aversion, dollar will definitely strengthen at this point. So that's why all the other Asian currencies will weaken. But I think what's putting added pressure on the ringgit is oil prices. As you can see that ringgit has been pressured more of late, because of the collapse of WTI, and also putting pressure on Brent oil prices. And also I think when Fitch, although all the rating agencies, they affirm Malaysia's sovereign rating outlook, but Fitch actually cut Malaysia's outlook, not the rating, but just cut the outlook to negative, given that there's massive growth uncertainty, and there's also a lot of uncertainty of whether Malaysia's fiscal deficit can remain as stable as what the government is projecting it to be. I mean, they are only projecting fiscal deficit at 4.5%. And given that all prices have probably half of what it was last year, so obviously there's a lot of uncertainty on the fiscal side as well. So, but I think for now, so far, the positive is that Malaysia can still maintain a current account surplus this year, about 1 to 2% of GDP. Our foreign reserves are still holding above 100 billion. And I think there's still a lot of areas where the government can manage. If oil prices drop further, they can get higher dividends, whether it's from the GLCs, asset sales. So there are areas where they can patch the to fill the gaps. So I think if things continue, if things actually are such that we are able to come out of this by May, and we can see some kind of recovery in second half, then I think we would be able to avert a much deeper recession. So I guess, yeah, it really depends on how this COVID-19 situation evolves. But so far, based on the numbers coming in, looks like we have been able to keep numbers under control. So fingers crossed, hopefully, that we can all come out of MCO soon. Okay. I'll stop here for.
Okay, good afternoon, everybody, and hope everybody is keeping safe. Today's presentation was prepared before the fateful announcement last night on the MCO extension. So various sections of a report that we released yesterday, which is encapsulated in today's presentation, are of course a little bit outdated, but I'll highlight if there's any changes. Now, for example, some of the changes is that the original title of this presentation is Healing Process. But if you saw this morning's write-up we had, it was a little bit of a critiquish on what the government has done. So it's changed to grave consequences. So I now fear that the government actions on MCO and the inactions of providing further aid for SMEs could be snapping the economy's elasticity. Yeah. So in that sense, our year-end target of 1440, as you see here on slide 1, that is obviously going to be downgraded alongside with our earnings expectations. But the gist of this report has relevance still, and we still feel, number one, that the KLCR has bottomed out at 1220 in March. And what is quite relevant in this presentation is the post-MCO presentation on the investment strategy, albeit the timing is a little bit off. Now, before we talk about expectations and prescribed strategy, I just want to have a quick year-to-date review on what has happened to Malaysia, right? It's important to have such reviews. And well, we all know it's been a disastrous year of triple whammy for Malaysia, right? We started off with the backdoor government, and then we have this horrendous COVID-19, which of course evokes horrendous images of Donald Trump as well. Side joke lah. And of course, that has created a big fallout in OPEC, shedding black tears, so to speak. Now, just to touch on the global toxic prescriptions on handling COVID-19, the global scale of such prescriptions or lockdowns have been obviously quite toxic to economy and capital markets. Now, just to zoom in, what has happened during that time in March when all these lockdowns were announced, we saw unprecedented volatility in equity markets. And we saw spasms of ups and down limits in S&P 500, for example, which corresponds obviously to the unprecedented rise in VIX or market volatility. Such volatility is related to the manic state of the credit markets, obviously. And you can see on slide 5, this chart, that there was a spike even in the credit spread for investment grade securities in the US. And that is what caused a lot of concern. Now, fortunately, having said that, central banks were very fast and swift to step in to provide monumental liquidity to end such a market calamity. So we don't expect markets to return to such hysterical situations anymore. And this is the big difference when you assess how this market behaves today compared to previous past financial crises where governments were not quick enough to provide the flush of liquidity. And lastly, just to highlight, it was an unusual period in March where even all capital market instruments did not work. Even gold had a fall as well during in March, and that kind of like highlights that the market has capitulated. So in Malaysia, of course, what we are really worried about is the meltdown in crude oil and CPO prices. So the question is, what does this spell out for Malaysian economy, right? With all these things being said and done. Now, I wouldn't want to repeat what Julia had mentioned earlier on. And you also know that in the market, other economies have even taken a more drastic and pessimistic view that GDP will contract as much as 6%. To give you a sense of perspective, 6% is very close to kind of contraction we saw during Asian financial crisis for Malaysia. So clearly, there is downside to our earnings forecast. We had, before last night's announcement of extension of MCO, downgraded earnings by about 8% due to COVID in various stages. And before then, or before last night, we were expecting the market to contract by 2%. That may be too optimistic now. And we need to crunch our numbers again and be able to come up with new numbers on earnings forecasts within the next few weeks or so. But I want to emphasize the damage done by MCO extension is no longer proportional to the time of extension. It's amplified situation, it's amplifying the pain, and it will affect a lot of business establishments in terms of the way they look at businesses in the future. So I fear that it's gone beyond the break point in that sense. That's going to affect not only business closures, job cuts, but also affect for companies that survive reinvestment plans into Malaysia, and that would imply that the growth prospects for Malaysia is also affected for 2021, not just only 2020. Okay, and as you can see from the various slides 8 and slide 9, and various media reports which were produced in slide 8 and slide 9, that you're familiar with some of the stern warnings provided by Federation of Malaysian Manufacturers, for example, warning on job losses, on cash flow issues here that we highlighted in blue, and also Department of Statistics gauge on households spending plunge, which is highlighted on slide 10. Again, these slides are reproduced from various media reports, but it does provide a stark reminder on the effects of MCO. And again, the MCO that we have is very unprecedented, is the longest period compared to the rest of the countries have imposed forms of lockdown. So the implication is that the recovery will be very slow, and that takes into account that our fiscal injection, direct fiscal injection, is only about 2.4% of GDP. Sorry, that's a typo of in this presentation. It says 2.6, but it should be 2.4% of GDP. But we may be right, because maybe the GDP may contract more than what we think. So implications for earnings is, again, there will be downside, significant downside to our current forecast. And incidentally, 2020 will be the 5th consecutive year of earnings contraction for corporate Malaysia. And what more, right? Of course, there's this potential that another phase of MCO will be introduced beyond May 12. That's the current concern of the market right now. And even with the recovery that we expect in 2021, again, these numbers will be reduced. The sense that we get is that the absolute earnings that corporate Malaysia will produce in 2021, even with recoveries, will probably only match the 2019 levels, i.e. 2 lost years. And what is crucial is, of course, the government's future response, right? We talk about inadequate, in our recent report, inadequate mass testing that doesn't give much confidence for people to come out, or confidence that the MCO will end soon. This brings back the question, what's the government's reaction is going to be like if we have a rise of infection, and or at least reinfection cases, which we've seen in South Korea. So it doesn't exude confidence how the government would respond to such situations again, because in the latest MCO announcement, the government did not exempt Penang from MCO, despite the fact that Penang Island has 0 cases for at least 1 week already. They did not talk about or elaborate on what other new businesses they are going to relax, right? And like we mentioned earlier on, our channel checks show that there doesn't seem to be preparations for mass testing and action plans to address how they're going to deal with the illegal foreign workers beyond when all the dust settles. But having said that, the question that's begging is, have we seen the worst for our market, right? So having said all these negatives, the sense is that, yeah, we should have seen the worst in March when the market hit 1220. On a price to book basis, that trough that we've seen in March matches the trough we've seen in the previous financial crisis, with exception, of course, of the Asian financial crisis. That was a really crushing crisis, obviously. In that crisis, GDP contracted by about maybe 7–8%, and corporate earnings was totally wiped out, right? And to get a clue on whether the markets have bottomed out, I think we always have to look at the US equity market, the market leader, right? So that means a lot of comparisons made to the Great Depression. So we provide 2 slides, whether the market is going to be following the trajectory of the global financial crisis, or whether it's going to be following the trajectory, treacherous trajectory of the Great Depression. Yeah. So even though the markets have rebounded a fair bit, and you wonder, is the US facing a recession, given that the markets have rebounded so well? There are still 2 camps. Yeah. So the bear camps would say that once the economic effect is felt, and it's very deep, as you all know, markets are going to come right tumbling down again, and it could hit the new lows again. That's in the minority, but there are some people who continue to believe that this could be the case. Of course, the bull side, they highlight the free flow in monetary policy, which is very crucial to sustain market psychology, and also to push actually the markets up. There's some people who believe that the market can hit new highs because of that liquidity push. For me, my take is that I'm more on the optimistic side, because liquidity is the key difference between this crisis and the previous 2 crises, as in the globe, especially against the global financial crisis. So the massive liquidity injection is the lifeline that this market needs, and is gotten that. And the other, of course, minor thing to consider is that prior to COVID-19, the US market and economy was actually ragingly hot, right? The average household balance sheet was a lot stronger compared to the GFC, and economy is a lot more robust. So the thinking is that behaviorally and financially, the markets will recover quicker in US. Maybe not so much in Malaysia, but at least that will lend support to Malaysia. So in all probability, Malaysia has bottomed out. And right now, in terms of valuation-wise, right, we are trading at, again, we have already troughed at about 1.2 times, similar to the GFC levels. We're currently slightly higher than that on the price to book basis. Now, you might ask yourself, in terms of PE basis, how has Malaysia done? We actually troughed so far in March at a much higher valuation compared to AFC and GFC. So we troughed at about closer to 13.5 times. So the question is that when earnings seasons unfold and we continue to cut, all likelihood will cut earnings, will the market fall to that low trough valuations matching GFC levels? We don't believe so, because the key difference is liquidity. So for now, we still feel that the market has bottomed out, is trying to of course, come off to an interim bottom again before making some recovery. So let's see how our convalescent strategy is focusing on post-MCO landscape. So every crisis creates opportunity, as you all know. So let's explore how we can take advantage of that. But the rules are laid here in this slide 19 to highlight that what we believe right now is we previously said it's going to be a U-shaped economic recovery. Now that's of course put in a little bit into question, and I'll highlight that in a short while. But the rest of our prognosis are very are kept intact, i.e. we expect the ringgit to weaken as the federal deficit rises. Now I know that the MOF has come out to say that the ceiling deficit is going to be 4.5%, but if you crunch through the numbers on expenditures versus revenue and whatnots, you come up with very horrendous numbers, which can be, of course, addressed partially by off-balance sheet actions and whatnots. But I think eventually the market can see through that and can weaken a bit more in terms of the ringgit reaction. At the same time, even though we're recovering equity-wise, the FBM KLCI will underperform advanced economies, simply for the fact that if you look at our MCO, again, it doesn't produce a lot of confidence because it's way too long compared to other lockdown periods in other countries. Ours already matching Italy, and Italy's situation is very dire. And more importantly, the closure period is not matched by enough direct fiscal injection, nothing at all compared to what other advanced economies have injected in and paid directly the people so they can more than comfortably survive through that lockdown period. So, what's the shape of our economic recovery post MCO? U-shape, V-shape, or the Nike swoosh actually. So I think that one of the clues that we can get out of China is that so far it's between, unfortunately, you and Nike. Yeah, because if you look at the consumption, industrial production has come back up very quickly. Yeah, close to where they were before, but actual domestic consumption trends, you can look at retail sales. It is still subpar, right? The horizontal line is when the lockdown ended. Yeah, and you can see that even after the lockdown, because of social distancing, catering services have crashed further. So in overall, the sense is that early days yet, no doubt, but in March data, you can see that 1 month after the post-lockdown, that the consumption trends are still maybe about 20 to 30% below pre-lockdown levels. Again, it's early days yet, but whatever China shows in terms of their recovery trajectory, Malaysia will be weaker. So we have a fair bit of a sense how Malaysia is going to recover. Now, on to our convalescence strategy, which I will strategize in terms of 2 stages. Yeah, first is the post-MCO stage, which comprises second quarter and maybe stretching up to fourth quarter now. Originally, we were expecting second and third quarter, but because of the stretch MCO, I think the recovery period will stretch towards maybe mid of fourth quarter. So characteristically, post MCO stage 1 will have effectively 3 stages to it. Yeah, you will have first at the beginning some optimism as businesses get to restart, but then reality check in the middle as there's a sense that the consumption recovery may not be as good as expected, will be slow, before market sentiment improves again in hopes that there'll be containment of the disease or herd immunity being achieved elsewhere globally, hopefully, or vaccine being created or cure. So in the stage 1, again, it's going to be fairly volatile in terms of market characteristics. You'll be first up, down, and then up again before you turn more risk on in the fourth quarter. Yeah. So the strategy we employ, of course, is that in the in the stage 1, you want to have some moderate venturing out, i.e. trading ideas, but generally you want to do a bit of a stay safe strategy, i.e. high yielders and defensive companies, which we'll elaborate in a little bit more. It's only in that towards the fourth quarter, and again, it's probably sometime in could be mid or end of fourth quarter, that we can focus on cyclical recoveries, high beta plays, get more adventurous with our investment strategies. Yeah. Now, in this quarter, don't forget there are a couple of things, events that you got to consider as well in the middle, right? First is on the political side. Parliament is going to reconvene that in July, that will allow a debate session. So the question is whether our Prime Minister will be challenged at that point in time. So that we'll only know in July, and the market will turn a bit more cautious. Yeah. And then the other thing to note is that engaging the economy, gauging how the economy is doing, we can only tell about impact on business closures and all that more precisely only post-September. Why September is because when the loan moratoriums end. Yeah. And that's a point where I think you know, it could pose as a break point for a lot of SMEs, whether they want to continue or not, or whether the NPL would rise sharply in our economy. Okay, so apart from this strategy, we also wanted to highlight in the piece that we just published yesterday afternoon, that this new social distancing behavior post MCO, of course, will have some trends related to it, such as reduced travels, more home entertainment, awareness towards hygiene. So we just highlight in this particular page that you have some key beneficiaries, and of course you will have your fair share of losers, which are obviously the aviation and the oil and gas plays. And another interesting company that could benefit from all this mayhem that's happening is MyEG, because obviously the services are quite crucial right now in trying to help monitor as well as screen through the foreign workers. Now, but again, I just want to highlight that our strategy that we prescribe really depends on government response to future relapse if there is, because that can throw things really off course again. And we really hope that the government becomes a lot more sensible after that. Now, to themes and picks that relate to our strategy, we just want to highlight three key themes. First is the dividend yield picks. You notice that some of the yield stocks have done very well this morning. For example, Astro has jumped up a fair bit today. But the idea behind picking all these companies would be that high yield companies that sustain high yields, they have rebounded from their lows, no doubt. But even if market falls back down again, I think these companies will be able to hold up much better. And that's why these are good interim companies to hold. But there are two, of course, two categories, right? The very safe category would be, or what I call very safe, meaning companies that can sustain their revenues. They're not affected by MCO, would be your likes of Astro and pretty much like your MQ REIT and BAT. Of course, the second level down would be the likes of Magnum. And then your third level down would be Genting Malaysia. The difference between Magnum and Genting is, of course, Magnum, basically they have low ticket sales, low value ticket sales. Therefore, in typical recessionary periods, their sales are very resilient. Their revenue is very resilient, provided they're allowed to operate. Less so for Genting Malaysia. So of course, now with the such a long lockdown period, their yield will be a bit more under stress. Yeah, whether they can maintain 2019 yields is a big question mark right now. They have the cash, but the question is whether, out of prudence, whether they will maintain or not. So this page highlights the list of companies that have fairly good yields. Just want to highlight, maybe we like CMB as well, but on valuation as well as on the yield basis, but again, it's more of a later play. The current play, of course, would be to stay safe. So these are some of the defensive large caps that we can highlight. Companies, again, what we mean by defensive are companies that can sustain or largely sustain their revenues even through the MCO period. So that would include the likes of Dialog, DG, some food and beverage companies like Nestle, QL, and even Westports. The last category, bearing in mind that we are a bit more bearish on the ringgit trajectory, would be the soft ringgit beneficiaries. But I want to tie that in with tech companies because you need companies with good revenue prospects to tie in with the weak ringgit part. So in this respect, I can only look at more convincingly at tech companies. So tech companies are mid and small caps. These are the three companies we listed here: Globetronics, VES, and Inari, that are more like a small and mid and large cap companies, or rather mid cap companies. So mid caps are not really in big favor when the market's in the consolidation phase, but I would take that as a buying opportunity if you see some weakness, because what's going to bring them up to the next level is, of course, the launching of 5G, which is not too far off towards year end. Coming to the last few slides, just want to highlight our topics, which we just introduced. Kosan is one of our top pick. Kosan is more like insurance play, as you well know. It's one of those rubber glove manufacturers is one of those categories that have benefited from COVID. So the sense is that coupled with being a beneficiary of the weak ringgit, the valuations can sustain for a while, even though they're not particularly cheap. We definitely prefer Kosan for its valuations and better growth trajectory compared to the other peers that we cover. But you can see here, in terms of our groupings, that we like a lot of yield companies, right? So the immediate yield companies will be your Astro, BAT, Magnum, Genting, and Tenaga as well. So a lot of yield defensive plays. And this is where I will stop. And I'll take the questions from Miron.